All right, okay, good afternoon. Just to do a very quick double check in terms of the audio and the screen, are you guys able to look at this and hear the audio okay? If you guys are in and you can hear it, help me to just type okay in the chat so that I know that everything is working well. All good? All right, okay, good. Okay, so we'll get started for the session for today. Okay, so this is actually a little bit of a follow-up from the previous session that we did in terms of structured demand and supply. Okay, so today we'll add on another element, another layer to help us move closer towards how we can identify certain entry areas as well as potential targets. Okay, so a quick kind of refresher, last session we cover in terms of how to identify the market structure in terms of are we in the bullish market or in a bearish market structure, and the direction and therefore we want to be focusing on. Okay, so concepts, and principles that we covered last session includes how to identify swing high, swing low, how we identify and define a break of structure, etc. Right? So hopefully you guys do remember a little bit what we covered. Then today's conversation and topic over here will be talking about Fibonacci ratios. Okay, how we are gonna understand and study the relationship using Fibonacci ratios. Okay. Good. So quick one over here. Before we jump into the content, you might want to, if you forgot, right, you might want to log into your MQ account, right, so that you'll be able to chat on the chat box over here. You can ask any questions. Later we do have some Q&A as well as some mini quiz. Okay, so you may want to make sure you are logged in. Okay, if you're not done that, you want to do it now, I'll give you maybe a couple of minutes as I'm explaining at the front. You can do your check-in. Okay, and of course, if you have check-in, you'll be able to get 300 MQ points by attending today's webinar over here. Okay, so what you need to do, of course, is to take a screenshot, complete the quiz, and then upload the screenshot during the post webinar, and you'll be able to then get a reward of 300 MQ points. Right. Now, of course, you also want to register for the update. Okay, so you can actually scan this QR code over here. Okay. Now, by the end of the session, we do have some mysterious gift for you guys as well. Okay, and of course, that includes a little bit of a quiz. So you definitely will want to pay very, very close attention. Okay, pay attention to what we are covering today. That would actually help you to answer those questions. Okay. Good. And of course, today, if you're very, very new to VC Plus, okay, what you can do is you can scan this QR code. And then, of course, you can head over to the website vc-plus.com and register for a free account and practice, kind of explore a little bit on the platform. Okay. And when you're ready, you can then actually verify your account and then put in a deposit from there on. Okay, so the QR code over here, you can also scan it and PM at me, and someone will actually come in and support you guys as well. Okay, good. So that's a quick introduction in terms of some of the things to note. Okay, very quickly over here, I'll just do a 1-minute introduction about myself. For those of you who perhaps joining in for the very first time, okay, or perhaps joining in for the first session that I'm conducting, just very quick introduction about myself, right? So my name is Karyong. I've been trading since 2012, and throughout the years, I've come across many different techniques and methods. Okay, I've also personally tested out many different strategies, and I always highlight this to fellow traders. It really doesn't matter which strategy you use, because at the end of the day, all of them has their own strengths and weaknesses, right? You need to just find out which one fits you as an individual, and risk management is definitely very, very important. Okay, so I managed to turn full-time doing trading, investing, and being in this industry since 2015. Okay, and since 2015 into today, basically that's what I do almost on a regular basis. Okay, so I really enjoy this entire process. And what I really like to do is to always share what I've known, what I've experienced, what I've learned in the market with fellow traders, and hopefully we'll be able to benefit you guys as well. Okay. So I'm quite active on social media, whether is it on Facebook or Instagram. I do post regular content as well. If you're interested in those, feel free to follow me on social media. Okay. But just take note that there might be some fake accounts out there, okay, trying to scam people. So just be very vigilant as well. Okay, so any accounts that reach out to you via private message or direct message and ask you to invest, transfer money and sort of, those are actually all fake accounts, right? They're scams, right? So just don't fall for those. Okay, good. So with that, we'll dive into today's conversation about Fibonacci ratios. Now, some of you may have experience using FIBs, right? Whether is it Fibonacci retracement, Fibonacci extension, or even Fibonacci expansion. So today's application of FIBs, right? It's not just about the relationship of where to pull and stuff. Okay, those are quite basics, I would say. But today we'll talk a little bit on how do we combine fibs with the structure kind of approach towards trading, right? So of course, first thing here, we're going to talk very quickly an introduction about fib, right? And one of the very common technique is called retracement. Okay, so fibs in general, we have three types, right? As I mentioned just now, retracement, extension, and expansion. But the most common one often used is retracement. Okay, so the idea of Fibonacci ratios is, they are not some kind of like magical number, or some traders would call it an indicator. But for me, I look at it as just simply a tool. Okay, so this tool here, Fibonacci, help us to measure certain areas and certain key levels that price has a good tendency of moving towards or even reacting at those areas. Okay, so think of Fibonacci as a ruler, as a form of measurement tool, and nothing else, right? So it's essentially just that. Okay, so retracement itself, more specifically, is often used to measure the correction of a trend. Now, so last session we covered, right, if we have a break of structure to the upside, if the market is moving in terms of a higher high, higher low, okay, we have swing high, swing lows, lower low, high high, high low, then we are in a bullish market structure. Okay, so when we're in bullish market structure, any form of movement back to the low side of price is what we term correction, right? It's a pullback. So what we then can do is we can utilize Fibonacci retracement to help us measure the correction, help us measure the pullback. Okay, so in terms of like, did it pull back very shallow, or did it come down or pull back very deep? Okay, so how do we know? We use Fibonacci retracement, Fibonacci ratios to help us define that. Okay, so using this kind of ratios here, we're able to then establish an expectation in terms of like, okay, there's a good probability based on historical statistics, the correction would likely come towards, this particular key area. Okay, whether is it a 50%, Fibonacci 61.8, 786, or 86, etc. Okay, so again, a lot of times I see traders, they like to do things like, oh, if it reached 61.8, that's where I'm going to enter and then buy or sell. Okay, now you do not want to do that because the ratio itself has a certain probability, but it's not going to be very high. Okay, you need to always stack it with additional elements like, are you following the trend? Okay, is there any other kind of like criteria that support you getting involved in a trade at that particular fib area? Okay, so fibs is what we use for confluence. It's an additional aspect to our analysis. We don't use it just because it reaches 618, for example. Okay, so over here in terms of Fibonacci retracement, there are some key levels that are more commonly used, and that would be your 236, 382, 50%, 618, 786, and 86. Okay, now they are not equally important. Okay, so for example, if you take a look at 236 and 382, it's a very shallow retracement. Okay, often we won't see the market actually have a very strong reaction around this two level, 236 and 382, because it's very shallow. Okay, but again, it really depends again in terms of like the asset and the securities they are trading. Some asset, when they're trending very strongly, you can be a little bit more aggressive in entering areas between 236 and 382 with additional confluence. However, if you're looking at FX market, right, currency market, most of the time, the retracement you would want to expect is minimum around the 50 and 618. Okay, so 236 and 382, we seldom really use it, but most of the time, we're going to focus on that 50 and 618. Right, 786 and 86 is actually a very deep retracement. Okay, and it's kind of hinting to you, maybe the trend is not as strong anymore, but there's also a good chance of probability where we may see some potential trade around those zones. Okay, so I just want you to be aware of such common retracement levels. Later, we're going to combine it into the charts to let you see and understand better how we use it, right? What's the application of it? Okay, so for you to pull it and use this tool correctly, okay, you don't anyhow pull it, right? You don't open a chart and then immediately the first thing you do is to take fibs and pull it. Okay, the first step is always to identify what is the current trend, right? And last session, we covered objectively in a very mechanical way how we can define the trend. Are we in a bullish market structure or bearish, right? So this is where you can best identify using the concept of market structure because it's very mechanical. There's no guesswork, okay? And we have clear definition of what is break of structure, how do we identify bullish or bearish market structure, okay? Now, once you establish that, okay, last session we also cover, how do we define where our swing high and swing low points are, right? It's not just any part of the chart, okay? We have very, very clear definition to that. So that's where I say, this session here is actually a build up, a follow up from last session, okay? Everything's kind of stacked together. So once we identify the trend, okay, then we can start to use the tool. Now, when you want to use a Fibonacci retracement tool, you need 2 points, right? You need a high, you need a low to help you measure a certain move, okay? So which part of the chart do we use it to measure and use this tool? We want to use it from a swing high to a swing low points, right? And last session, we cover how do we mechanically define swing high, swing low, okay? So you always want to pick the high to the low or the low to the high, right? Depending on the direction of the market trend as well, okay? Now, I'll give you an example before we move on to extension. Okay, so let me just clean up everything. Just pick an example. Let's say I'm gonna take gold, right? Gold here is often one of the most common ones. Okay, now it doesn't really matter which time frame again, because most importantly, you are applying this in the time frame that you're trading, and then you just need to adopt one higher time frame to give you a bigger context. Okay, now let's take a look at the gold chart. This is based on hourly. Right. So based on an hourly, I think this is quite clear in terms of market structure. We have a bullish market structure, right? The reason is because if you take from this low here, okay, quick recap for those of you who can't really remember what we covered last week. Okay, this is your swing low. Okay, the market went up, it came back down, and then it went back up, and we get a break of structure over here, very obvious, right? The candle break and close above it. So if this is a break of structure and the market is giving us a higher high, higher low, we're technically in a bullish market structure, okay? And what we then do is we need to update our swing low, okay? So the market actually had a break of structure here. Where is the lowest point within this zone that resulted in the break of structure? Is actually this low here, right? So that's where we're going to update our swing low towards that low point. Okay, so you can see that's where swing low is. The market went up, it starts to pull back, and therefore this would end up being our swing high. And of course, just recently, yesterday, we can't get another break of structure. Okay, so let me update that. Okay, BOS. Now I'll just play back a little bit just to show you the fit relationship fits, right? Now, last week, before the market actually break and close above, this would just simply be a swing high, right? So we're swing low, we're swing high, we have a break of structure, higher high, higher low, bullish market structure. So from this perspective, if you want to pull fits, okay, I will need to pull it from swing low to swing high, right? We're pulling it in the direction of the market trend. The market trend is up, so we pull from low to high. We don't take any swing low, right? We don't take from this low here to this high. We need to take the swing low to the swing high, right? That's how we measure it. And over here, I'll just put the fits for you to look first, okay? Now, I've color coded a little bit here. Later on, I'll explain what they mean. But you can see the fit levels, right? 236, 382, 50, 618, 76, 86, right? So that's how we do it. Okay, so what does this mean? How do we look for entry? That's what we're going to cover as we follow through and move forward in today's session. Okay, but I just want to do a very quick example in terms of how we pull the fits, right? Swing low to swing high. That's why you need to be very clear how to define swing low and how to define swing high, right? So that's on the retracement, how we pull it. Okay, so if you understand retracement, then you also need a certain target, right? Because retracement, we use it for potential entry where the price would likely pull back where the price will likely react. Then we use the opposite, which is a little bit on what we call an extension, right? Retracement is a pullback, so extension is a move going higher in an uptrend. So extension over here is used to mainly for target profits, okay? So extension is where we want to look up for areas in which the price may be exhausted, and therefore that's where we're going to use for target, right? So if you're buying it, then we expect the price to keep going higher and break new structure. But where would we put our target? We can use the extension to guide us, right? So extension here, we have 3 key levels: 118, 127, and 1618. Okay, so the most common ones is naturally 127 and 1618. Okay, but depending on, again, how deep the retracement is. The deeper the retracement, okay, the shallower the extension is going to be, because it's indicating that the trend is not as strong. Therefore, you don't put a very high target, right? You want to be a little bit more conservative. Now, this relationship doesn't necessarily mean it's always 100% accurate. Okay, this extension are just reference point for target. It has a high probability of reaching the target, but it's not going to be all the time. Okay, so the relationship over here is this. So just now you see a color code, right? So to make things easier, okay, the relationship is if the retracement comes back towards area between 236 and 618, then there's a good chance the price will head towards 1618 extension. If the price retraces towards 786, there's a good chance the price will head towards 127. And if the retracement is very deep towards 86, then you don't want to target too far. Okay, you just want to put your target somewhere around 118. Okay, now to show you back onto the chart what that looks like. All right, so you can see over here, okay, we kind of have different target colors, right? So the idea is quite straightforward. If the pullback is within the red zone, we would expect if it starts to go, likely target is here. If the pullback is deeper and it tags the blue color, 786, then we'll expect it to come back towards 127. If the pullback is all the way to 886, then there's a good chance we'll not see a lot of upside. Target here is somewhere around 118, right? Now, why are this extension? Because it actually breaks above that swing high. That's the target. Can follow, right? So not that difficult. When we color code it, it's quite straightforward. Red to red, blue to blue, green to green. That's all, right? So I'm going to give you some examples back onto the chart. Back onto the PowerPoint slides first. Okay, so you can see over here, this is a drop. Okay, the market pulled back towards the area between 618 and 786. But the key thing here is it did not touch the 786. Okay, so when it did not touch the blue line, though it go above the red, we still take it as retracement equals 618 because it never touched 786. Okay, so because this retracement is in the red zone, our target, our eventual target is going to be at 1618. Okay, and that's where you can see the market actually went down and touches the 618, and then we have some kind of reaction. Okay, now can the market move more than that? Yes. Can the market move less than that? Yes, but high probability is where, okay, we'll be able to actually see some reaction over there. Can follow through, yeah? Okay, so give you more example, right? So if you have an up move over here, right, when the pullback is towards 618, you can see never really touched the 786. Then what you expect is the relationship is going to go all the way back to 1618. Okay, so you can see very nice little move, right? This one extended a little bit more, but again, you don't want to be, overly extended. Sometimes you just want to get up, okay, around that 1618. Okay, good. So let me go through some more examples over here. Meanwhile, Okay, so I'll also use some examples to run through the charts on VC Plus, right? But you need to give me a bit of time to set things up over here. Let me find gold. Gold XAU. Let me search it out. Okay. Okay, let me just edit a little bit now. Let me change this to okay. I think color wise, just change the. Let me see that. So let me just change the color so it becomes a bit obvious. Can't see the price color up here. Okay. Let me zoom out. Okay. Okay. So this we don't have to play back. Okay, but then we'll just work moving forward from here, right? Let me just also edit this. Okay, so usually we'll do in color for the 236 straight to 50 and 6.8, right? Okay, so this is how we update this. Okay, so 786 to blue. We take this blue. We need to add a 8886 over here, right? So the green. Okay, so the extension you can edit, right? So 1618. Usually what I can do is I can just do a negative 0.618. That would then just flip it, right? It will flip it to the upside. So this would be a red zone. Okay, let's take away that. And then we'll add in a negative 0.127. Okay, so that will flip that here as well. That will be blue. Okay, and last one here is 118. So that would be green. Okay, so this is how you can edit in terms of the levels that you want. Okay, and then of course yeah, okay, so we just stick to that, right? Now so that's the edit of it. Okay, so I just want to show you, right, the relationship of it. Okay, so just now we kind of have from here. Let me just take away all this. Okay, so we have this as a swing low, right? If you recall that then would be a swing high. We got the break of structure. Okay, just now we pull from swing low to swing high. Okay, let me just extend this to the right. Okay, good. Okay, so you see this here, the pullback actually came back to its 50%. Okay, and it starts to bounce, right? So we have a red zone. Okay, so naturally, where would be our extended targets? Okay, I need to move this. Okay, where would be our extended target? Our extended target would then be the next red territory, right? So we'll be expecting this to go all the way. You know, it may come back, it may do whatever it wants, but there's a good probability it will eventually reach that negative 618, which is our 1618 extension, right? So that's the relationship behind it. Okay. Now sometimes you may get a pullback maybe towards like blue. Okay, and then of course you wouldn't want to target too far, right? Because if it comes back to 786, your next target is just about 127. If it touched the 886 or around the 886 area, then you expect this to only come down to 118, right? That's the idea of it. Now, does it mean that you're just gonna straight away put your one target here? No. Okay. So for example, gold chart over here. Okay, let me just remove everything. Gold chart over here, what we did, okay, is we will always suggest that before all this happened, right? Before all this, you can't really see that yet. When this pulls back, you have a target. We have an extended target at 1618. We know that, right? Because it pulls back here, it gives us a reaction. But you do not want to immediately, just have one target. What you can do is you can have multiple targets, right? TP1, TP2, TP3, okay? So you can actually then set, okay, my first target is here. My second target is there. Or maybe you want to have TP1, TP2, TP3, up to you, okay? But the idea of the relationship of fibs, retracement and extension, is that eventually, if we have a reaction in the rate this starts to kick off, you want to take profit there. You don't want to be overly greedy about it. Can follow that, right? Because there's a good chance from here we may see a bigger pullback eventually, right? So that's the idea of it. Okay. I see some of you are asking in terms of how can we adjust the approach. For example, Giovanni here asks, right, how can traders adjust their approach when using Fibonacci ratios and market structure in different types of market, such as trending versus range? Now, good question. If the market is in a range-bound environment, you wouldn't want to use mainly the retracement or extension, because the idea of it is when the market is in a range. Okay, I'll give you an example, right? We zoom in a little bit over here. Okay, now suppose the market is here, right? So we're kind of trapped in this range. Okay, so when we're in this kind of environment, there's no way you're gonna use Fibonacci to your advantage. Okay, the reason is because we don't have an obvious swing high, swing low, and in addition to that, we don't have any structure in place for us to actually catch the trade. Okay, so where are you going to pull your fibs, right? So you do not want to anyhow just pull. You don't want to just say, okay, I'm going to take fibs from here to here, or I'm going to take fibs from here to here. Then the entire thing is you're not really leveraging on the proper approach, understanding the strength of fibs, right? So when we are looking at a market and you start to identify, okay, that's why I say the first step is not to immediately pull fibs. The first step is always to first identify and understand, are we in a bullish market structure or are we in a bearish market structure? If you kind of identify that clearly, means that if the market is not very obvious right now, giving you an uptrend or a downtrend, you don't want to trade that market, right? You want to move on to the next market and start to identify clearer market structure, such as whether is it buy or sell. Okay, and then only you start to use the fibs, right? The fibs is actually your second step. It's not your very, very first one. Okay, so I hope that answer questions in terms of how do we deal with ranging and trending environment. Okay. Okay, so TCY here asks, based on Fibonacci, how can we set stop loss and take profit? Okay, I'm gonna use back this example on gold. Okay, so over here, what we've covered so far from last session is how do we identify market structure using certain definition of swing high, swing low, break of structure, etc. Right? Okay, so we kind of have this swing low here. Okay, and okay, just visualize a little bit, right? This one before it happened today, right? Because last week we were not there yet. Okay, so we pull our fibs, right, from swing low to swing high, and we identify the red zone. Okay, so of course, just like I mentioned, we don't just trade because the fib is there. Now, there's another concept over here that we look into in terms of structure, supply, and demand. Is basically the principle of supply or demand, right? Or we say supply and demand. Okay, now this area here is essentially a very strong, or I wouldn't say strong, but basically it's a valid supply demand area. Okay, now the market is in a bullish market structure, so this is what we call a demand. Okay, of course, right now you can see a very nice little reaction. Again, it's not 100%, but the probability is fairly high. Okay, now why is this a demand? Okay, because what we are looking at is what we call imbalances, right? So if you take a look at these three candles, I zoom in a little bit, huh? Okay, if you take a look at this three candle over here, this peak and this candle, okay, that is a gap. Okay, this gap creates what we call a market imbalance, and therefore it's indicating that this one here is a good demand area. Okay, so that's how we identify it, right? Not all the candles would have it. Okay, now some candles will see an overlap, right? So this one you can see a gap. So it's a three candle pattern, right? This first candle and the third candle did not intersect. That gives us a market imbalance. Okay, so with that, we've actually identified this zone, okay, and then we add in the fibs. Then we saw, okay, within this zone, we have a confluence, right? Because other fibs, if I put it in, you see we're out of the zone, right? So 786, is below the zone, 382 is above it. So what we do is we just focus on the 50 and 618. Okay, so where do we identify entry? When we have a good confluence, we have identified the market structure, we have identified demand supply zone, we have identified fit areas, all this stack up together. This is where we look for buy, right? So we can put in two entry, right? One is at the 50, one is at the 618. That would be our entry point. Where would be our stop loss? Our stop loss zone, if you're very, very conservative, would need to go below your swing low. The reason is because the market can continue to pull back, but as long as it doesn't take out the low, we're still in a bullish market structure because it's still higher high, higher low. But if the market takes out this low, that's where we're no longer in a bullish market structure. You want to get out on any buy, right? So that's the part where if you're very conservative, that low is where you're going to put in your stop loss. Okay. Now, if you're a little bit more aggressive, right, meaning you're going for higher kind of risk to reward ratio, okay, you can actually decide to do this here, right? So we identify the demand zone. Okay, we have put in the fibs. We have identified two key potential points to get in, 50 and 618. What you can do is you can put in a stop loss just below the demand zone. Okay, now that's a little bit aggressive because what can happen is, as I mentioned, the market can pull back a little bit deeper and then bounce, right? So if you have a stop loss just below that zone, then that trade may get cut. You know, you need to get out with the loss because it hit your stop loss and then bounce out eventually. But then, of course, the benefit of it is in situation like that where it's ideal, okay, then your risk reward can be quite interesting. Okay, so let me just show you very quickly, yeah. Just to give you some example of risk reward comparison. Now, if you take a 50% entry, okay, and then I'll stop this here. Let's say I'll just aim for my first conservative target. That's going to give me 1:1, right? Because 50% mark. 1:1, that's the risk reward. Now, if you're going to take the same trade here, but my stop doesn't need to go all the way down, I'm just going to put the stop like just below the demand. And then my target is exactly the same. You can see the risk reward is 2.7. Okay. So each technique, right, whatever that you want to use, has its own strength and weaknesses. Okay. You need to then define, are you more aggressive or are you more conservative? Okay. But the general rule of thumb is you do not want to take trades that are less than 1:1 because that may mean, you know, you need to have a higher accuracy, right? But basically what we're looking here is anything risk reward more than 1:1. If today your accuracy is very bad, and let's say, you know, you can only catch 50%, half of the time you're right, half the time you're wrong, you still make money. Okay, so that's the whole idea of it. Okay, yeah. Yeah, so the question that follow up from TCY asks, what other indicators do I use? Nothing. This is basically all it is. Okay. So this is a solid trade that we're looking at. So give you update right now, right? Based on the latest market update. this is a break of structure, right? So we have the market break and close above it. So that's a BOS, right? It's a break of structure. Our swing low will then be here. Okay, then where will be our swing high? Our swing high as of now, temporary, will be this high, right? So we have swing low, we have swing high. We're in a bullish market structure. Do we have a obvious imbalance? Okay, now we do have a little bit over here. Okay, this one takes a little bit of practice, but you can see a little bit of this here. Why? Because there's a gap between this candle and the third candle. You can see the gap. So that is market imbalance. That would be a potential demand zone. Other than that, we don't really see it. Everything else is overlap, right? That's the only demand zone that is untested. It's new. Okay. So then, of course, we can pull fib, right? That's what we covered today. How do you pull it? Swing low to swing high. Okay. Now we want to find confluence. Okay. So 50 and 618, there's nothing there. So the confluence comes in at 786, right? So if 786, then it will be blue to blue. So what you're looking at here is if today the market decides to pull back, okay, towards this territory, that becomes an opportunity to buy with a final target at 127. Can follow that thought process, right? Now, of course, does it mean that the market needs to pull back? No. If the market just decide to keep going higher, then of course you won't be getting involved in the trade. You just need to reanalyze the entire situation. Can follow through, yeah? Okay. So that's the analysis on gold, right? Can you apply this on any other instruments? The answer is yes, right? But you need to have a very clear market structure. Okay. So if we take a look at, let's say, some other instruments, maybe we'll take, let me think, I think dollar yen has something. Let me, okay, we just keep it as white, I think, right? Or else, we need to keep changing the color. So we just keep it as white. I think that's fine. Okay, on the hourly, okay, not the best, but we do see a break of structure over here, right? Okay, so you can see here, the market actually broke this high, closed above it, right? So that's what we call a break of structure. Okay, and then where would be our swing low? Our swing low will be all the way at this low point here, right? Because that's the lowest point that broke and closed above the previous high. So on the H1, we're definitely in the bullish market structure. You can see that. Okay, and then of course we can start to pull fibs, right? So where will be our swing high? Our swing high will be here for now, and our swing low is there. So we're gonna pull fibs, swing low to swing high. Okay, I'm not gonna edit everything again, right? But I think you can understand, right? Without the color, we just focus on the fit, right? I think you can look at that. Okay. Now we again, I mentioned just now, right? We don't just buy whenever we see like 50 and 618. Okay, you need a confluence. So in terms of structure and supply demand, we are basically looking at, do we also have a obvious supply or demand zone, right? If the market is in a bullish uptrend, we're definitely looking for demand. We're not so interested in the supply side of things, right? Because we're interested in buying it. Okay, so we then look, from the swing low to the swing high, do we have an obvious market imbalance? Now we do have, okay, take away the background. Now we do have one over here. You can see this, right? Very, very deep. We have that gap, right? So that's definitely one. Other than that, we don't really have, we don't really have it. You can see that, right? So everything is cuff tested. Now you may say, hey, what about this one here, right? This one here, you can see there's a gap, but the market actually came back and tested it. Okay, so areas that are tested, we're not keen anymore, right? So we basically only have this. Okay, so usually, such a very, very deep kind of demand over there. Of course, if you pull fibs, let me just add that in. We'll probably add it. These things, right? The rest. Okay. So what we have over here is an not exactly in the zone, but the closest we get is the 86, right? So this means that if we can get the market to pull back all the way down here, there's a good chance we may look for a buy. Okay. Now, because the pullback is so deep around 86, okay, again, you don't need a massive target for your risk reward to play out. Okay. Now, let's just say you're more conservative, right? You take a buy around the zone, your stop naturally needs to go below that swing low already, right? You just need to target, let's say, maybe halfway through. Your risk reward is 2 point something. It's decent, right? You can put take profit 1 here, take profit 2 up here, 4.6. And then, of course, if you want to go for the final target, okay, that's where we say this would be 118, right? The final target will be just there, right? So that risk reward can go up to 5.5. Right? So that's how we look out for it. Now, understanding this entire principle, can we trade the downside? Yes, because this is on an hourly. If you go to a 15-minute, okay, or even smaller than that, okay, you may start to identify bearish market structure. Use the entire same principle. Okay, I did identify fib areas using fibs to guide you in terms of the relationship. Yeah. Yeah. So this can apply to even indices, right? If you're taking a look at, let's say, Nikkei is in a pretty nice little uptrend. Just saying. Okay, maybe just take US market. See if I can type the correct one in. Sorry, not currency. We just go to index. Okay. Okay, Nikkei, right? I think Nikkei is in a nice little structure, right? Upside. Okay. So you can see over here, we do definitely have a break of structure. Okay. The candle actually break and close above it. Then this will be our swing low. Okay. And what we'll be looking out for is, of course, temporary swing highs there. Okay. Then we can, of course, pull fibs, right? Swing low, high. Okay. So now we'll just put it like that. Just shift it. Okay. And will that identify, right? Do we have an obvious demand zone? Okay. So I think this one here is quite obvious, right? We kind of have a gap. Okay. Other than that, we have another one below here, right? You can see that. Okay. That's also a market imbalance, right? So we have two, right? So how do we deal with it? We then filter off, right? So we can't have a couple of like levels that are confluence. Okay. So we have the 50%. Okay, we have the 650 basically here. We have the 786. So in such situation, okay, you need to then make a decision, right? Do you just want to look for one entry, or are you gonna split your entry in terms of like, okay, we're gonna put in 1/3 of position here, we're gonna put in another 1/3 of position there, and then we're gonna put another last 1/3 of position there, and all my stops are basically below the swing low, right? Okay, so you can do something like that, and of course your target will be up there, right? So does it mean that we're gonna definitely get all three trades? No. Okay. It just basically means that you're prepared that if the market doesn't bounce out here or here and it goes deeper, you want to capitalize on everything and right on this move up here. Okay. So you can actually split your position into like 1/3, 1/3, 1/3. Okay. Now, what you can also do, of course, you can be creative in this, right? You can say, okay, I'm a little bit more aggressive. Maybe this one here are gonna put like that. Okay, can it be done? Yes, right? Because 50% here, you're a bit more aggressive. You're putting your stop just below this demand to increase your risk reward. Now, if that gets cut, stop out. Never mind. I will look for my second entry around the 618. My stop loss is below the second demand. If that cuts out, never mind. I'll look for the third. Now, I want you to focus on the risk reward ratio, right? If I'm doing this, you can see it's about 3 here, 2.8 here, it's about 3.5. So average is about 1:3. Suppose I lose this trade, and I win this trade. My average risk reward is what? 1:3. Okay, sorry, not 1/3. Yeah, it's 1:3. Okay, in fact, the last trade is actually more than that, right? 3.5. So what it means is that I can lose 2 trades here and I can win the last one, and I net end up still profiting. more than 1 hour, in fact, right? Because I get minus 2 hour here, I get plus 3.5 hour net. If 2 lose, 1 win, I still make about 1.5 hour. Okay, so that's the beauty and the importance of risk to reward ratio. Okay, now of course, if you are being more conservative and all your stops are just below that, and it came down and then hits all the way up, then you add up, right? This is about 1 hour, this is about 1.5, 2.5, 2.5, and then the last one here is about 3.5. That gives you a 5-hour return. Okay, so each of it has its strength and weaknesses, obviously, right? Because you need to then also consider, what if the market just comes down and bounce? Okay, so I won't get this 2 trade, and my only R here is I'm going to get is 1:1. Okay, so going to make like 1% if you risk 1%, right? So if today you only look at this being more aggressive, then that one single trade can give you 3R if it works out perfectly. Okay, so again, whenever you're making a decision like this, just want to highlight and show you that there is pros and cons, right? You basically needs to kind of like decide, right, which one fits your personality a bit more. Okay. Question over here I see is, what is the gap you mean, right? The gap here will basically, if I zoom in, okay, but looking at a 3-candle pattern, okay. So if you take a look at this here, this high and this high and this low, that's the gap. Okay, so this candle here and this candle here, you can see, right, the high and the low, that's the gap. Okay, so this is what we call market imbalance. Okay, so you want to use that to help you identify areas. Okay, right, so this on Nikkei. If you look at okay, Hang Seng, oops, I click on that. Do we have a market structure trend? Answer is yes, right? Very, very obvious, right? We can't have a break of structure here, right? Market basically open and close above it. So that's an uptrend. That's a break of structure, right? So our swing low is here, swing high is here. Okay. Do we have a market imbalances, right? I think this is super obvious. I mean, we get a massive gap. Okay. So this here to this here, that's the gap. I think you don't even need a 3-candle pattern, right? The gap basically means market imbalance. Where's your demand here? Can follow, right? If you see a gap like that on the stock market, it's very obvious. Okay. So what you do, you take fibs, swing low, swing high. Okay. Where's the confluence? 786. So the rest are not that important. Just take away. Okay. Then so that's 27. Okay. So how then you do this? How do you look out for it? If the market decides to pull back, okay, then we can look for upside, right? So that's the obvious one. Do we have a smaller little demand zone? The answer is yes, right? Okay, if you zoom in a little bit more, we have a little bit of a demand zone over here. Okay. So if you're looking at this, then your Fib confluence would probably be around that 236 and 382, which to me, I'm not someone who is very keen in trading this because it's a very shallow retracement. Okay. If you're gonna trade this, you do not want to put your stop all the way down there, right? Risk reward wise, it's not gonna be mixed. It's not gonna be making a lot of sense. Okay. Because if you look at this here, I'm gonna enter at 236, my stop all the way down there, and then my target here. My risk reward is like 1:1, and it's very wide, right? In terms of stop loss, it's very wide. What if the market doesn't hit the 1618? Okay. So if you're interested in like trading around the fits of 236 and 382, my suggestion is you definitely want to consider like just putting your stop below the demand. Okay, and then of course you don't need to target all the way out, right? You can take profits as it goes. You can see even with the 127 extension, your risk reward is already 2.5. Okay. Yeah. So any instruments, as long as we do have a obvious market structure, this is something that you can actually apply already. Okay, so we went through gold, we went through FX, we went through indices. Okay, you can see them being applied. Okay, crypto market, can you do it? Yes, given if the market is in an obvious market structure. Right? Bitcoin right now is in a range. Okay, so there's no clear market structure. Naturally, you don't want to be applying this into a chart like Bitcoin. Okay, um, you know, you want to always find clear market structure like this. Nothing there. Don't bother. Okay. You can of course play around with multiple time frames, right? I mean, I'm focusing on hourly. If you look at 5 minute, then of course things are slightly different. Okay. So what we have, let's just say if I apply this on the lower time frame, okay, we have this one here, break of structure, right? Where's the lowest point that causes it here? And then what happened? The market actually rotate from a bullish market structure to a bearish one right now because we get a break and close above this. Below this. So this becomes our swing high now. Okay, and the market is actually still moving a little bit to downside, but we are rotating. Okay, so if you still remember last session, this level here is called a change of character. It's the first sign that the bullish market structure is shifting. Naturally, you don't want to be buying it anymore, right? But you can be a little bit more aggressive and say, okay, it's a potential early downtrend starting to form. Can I look for sell opportunity? Okay, so of course you can do that as well. Look for areas that we have supply. This is the part. We have the supply there, obviously. I think we can even take it all the way down here because you can see the gap, okay, between that two. So this is basically the supply zone. Okay, so if you pull Fibs from swing high to swing low for now, okay, okay, so the confluence is somewhere around 786, 618. I think 886 would be there as well, or 0.86. Yeah, it's there, right? Okay, so that would be the area that we have a cluster of Fibs confluence as well. Okay, so this is a very, very short time frame. It's a 5 minute chart, right? So if this actually pulls back, here is where we can look for areas to sell. Okay. So even on like short time frames, can you use this principle? The answer is yes, right? So if let's say this is 618, then obviously we'll be targeting this, right? All the way down. Okay, yeah. Okay, so I kind of want to also show you like if it's a opposite direction, what you can do about it. Okay, so I hope that's clear. Okay, so I see a question here. How would you advise if you find something conflicting in terms of like the signals between RSI and such? Yeah, so you realize that I don't really use indicators. So of course, the more indicators you're gonna add on, there you increase the chances where you might get conflicting signals, right? Because um, the indicators at the end of the day is what we call a derivative of price movement. Okay, it's a set of formula to calculate how price move, and every indicators will have its own set of calculation. And the more indicator used on the same chart, you increase the odds that you may get conflicting signals. Okay, so for me, I really do not rely on indicators. The most you have seen me use is probably RSI to serve as a form of confirmation for divergence principle. But I don't use RSI to execute trade anyway, right? So over here in supply and demand structure, you realize that we don't really use indicators as well. We're basically studying the price itself. Okay, so for me, I would say if today you want to add indicators to complement the entire process, um, don't add too many things. Okay, and you want to add indicators that supplement the analysis principle. Okay, so for example, when we look at market structure, right, we have break of structure principle to determine whether we're looking at buy or sell, right? So today, if you add in a moving average over here, it's a little bit redundant. Why? Because moving average, the function of it primarily is to tell you the trend. But we already have a principle of break of structure, higher, high, higher, low, lower, low, lower, high to help us determine bullish or bearish, right? So adding in a moving average doesn't really add value to it, but it may cause confusion, okay? Or I may say it may cause conflicting signals at times, okay? So you need to also understand, like, when you're using an indicator, what is the primary function of it? What purpose does it serve? Okay, does it add value to the process, or is simply just, doesn't really add much, right? So if it doesn't add much, you don't want it, right? So like example of this, we don't really need the MA anymore because we have a principle to help us determine the trend, to determine whether we buy or sell. Can follow that, right? So I kind of hope that helps. Okay, good. Joel asked how to open VC Plus trading account. Let me just maybe go back to the front. There's a QR code over here, right? So you can actually go over to the website vc-plus.com. You can register for an account, or okay, you can scan this and then send at me, PM at me, and then they will be able to assist you on that. Okay, good. So I hope today's session has been helpful. Let's run through the. Okay, I don't want to overextend this so that you see the answer. Let me slowly scroll down. Okay, so let's go into the last portion here. Okay, where we have the mysterious give session. Okay, so what you need to do over here is I'm gonna flash out a question. In total, we have 3. Okay, and what you need to do is give the correct answer. Okay, and you need to be fast. Okay, so ready? Let's take a look at the first question. What do we use the retracement ratio for? Okay, A, to identify targets, B, to measure a correction, C, to measure the next move, and D, to look for entry. Okay, so you just need to type in the correct answer, right? Just A, B, C, D, right? It's a multiple choice thing. Okay, good. Great. So I see some of you are typing in D, some of you are typing in B. Actually, the correct answer is B. Okay. Now, I actually highlighted this a couple of times, right? I say that you don't just enter when we have a 50 and 618 fibs, right? What you want to do is you want to find a confluence, right? So the correct answer is actually we use the retracement just to measure a correction, right? Where would it likely go to get some reaction? But our entry is where we need to confluence it with a demand or supply zone. Okay, so the correct answer for this would be B. Okay, so over here, so yeah, so Robert and Doubtless, congrats for getting the right answer fast. Okay, so do fill in the Google form. Okay, so that MQ, Demi here will be able to send you the gifts, right? The mysterious gift. Yeah, so take note. Okay, the retracement is mainly for measuring. Second question. We pull fib retracement from A, swing high and low, B, candle closing prices, C, candle week to week. Okay, so how do we pull our fibs, right? From what point to what point? Is it A, swing highs and lows, B, candle closing price, or C, candle week to week? Okay, good. So the right answer, I think all of you are getting it, right? It's just a matter of who is fast. The answer is A, right? It's basically from swing highs and lows, right? So of course, if it's going up, you're gonna pull from low to high. If it's coming down, right, then you pull from swing high to swing low. You follow the direction of the market structure. Okay. So congrats, HF Luke 07 and MD Soy. Do fill in the Google form, right? Now, last question. Which of this is correct in terms of the fib relationship? A, 50% retracement to 127 extension, 86 retracement to 127 extension, or C, 78.6 to 127 extension. I think this one, if you pay attention, I think quite straightforward. You should remember, right? Red to red, blue to blue, green to green. Okay, so the correct answer is C. Okay, 786 to 127. Now 86, right? Some of you put in B, I saw. 86 is basically to 118. Okay, 50% or 618 is usually to 161.8. Okay, so congrats on Boon Chai and Yok Long, right? So same thing here. Fill up the Google Forms, okay, so that MQ Demi here can send you the mysterious gift. Okay. Good. So I hope today's session has been helpful. I think that's all from me for today. Do take what we've covered from last session and this session, combine them, okay, and then apply it into your chart, go and practice. This technique, you can use it on the hourly all the way to the lower time frame. And I would say you don't need to monitor a lot of instruments, right? You just need about like maybe 3 to 5. And on the average week to week, you get enough trade opportunities to execute the market. Okay. So good. That's all from me. All the best to your trading. Okay, take this, go and practice, and hopefully it gives you some insights and will be able to add on to whatever existing trading plan that you guys would already have. Okay, so all the best. That's all. See you guys in the next session. Okay, bye bye.
Thanks for watching.